So now I'm going to explain to you guys about the accounting concept. The first accounting concept is separate entity. This separate entity shows that the business entity will be treated separately from the businessman. In a simple term, there is no relationship between the businessman and business. For example, if a businessman takes money from the business for personal use, it will be recorded as a drawing. It will not be recorded as a business expenses. So the second one is going concern. Going concern shows that a company assume that they will operate for a long term and it not will be closed nearby the years. For example, if a company buy a machinery worth Rm10,000, it will be not recorded as a one-time expenses. Instead, they will use the machinery worth Rm10,000 by year and will be recorded by several years. So, the third one is consistency concept. What does it mean, consistency concept? Consistency concept refers to a company using same accounting method from one year to another accounting period. For example, if a company using single line method for asset depreciation, so the company need to use the same accounting method for another accounting period also.
So the first one is historical cost. Historical cost means assets are recorded in accounting records at their purchase price value, not their current value, but the original value. For example, if we bought a land that cost $10,000, it will stay $10,000 in the record even though the value increased. So, the next concept is materiality. Materiality means financial information is important enough to influence decision of users such as investor, management, and creditors. In simple terms, an item is material if leaving it out or report it incorrectly would affect decision making. Accountants use a professional judgment to decide whether it is a material or not a material. For example, a $10 error in a multinational company's financial statement might not be a material, but a $10,000 in a small business might be a material. So, the second one is monetary unit. Monetary unit concept states that the only transactions that can be measured in money are recorded in accounting. It also assumes currency value remains stable over time. That means it ignores inflation. So, the third one is conservatism. Conservatism means accounting should always cautious when reporting financial information. For example, accounting should record expenses and losses as soon as possible, and also records gain and revenues when they are certain, so that can prevent overshooting in profit and effects.
Now I will be explaining about accrual concept in accounting. The accrual concept states that when the revenue and expenses are recorded when they are earned or incurred, not when cash is received or paid. For example, if a company provides service in December and receive the payment in January, the revenue will still be recorded in December. So today I would like to explain about the accounting concept of matching. Matching concept states that the revenue must be recorded in the same accounting period as the revenue they need to generate. In simple words, when a business earns revenue, it must need to match the related cost to that same period. This helps to show the correct profit for the business. For example, if a company makes sales in December and needs to pay sales commission for those sales, the commission expense must be recorded in December even if the payment is made in January. Now I will be explaining about the accounting concept of objectivity. The objectivity concept states that all accounting records must be based on verifiable evidence and not personal opinion or bias. This means every transaction recorded in the accounting books must be supported by proper documents. These documents can include invoices, receipts, bank statements, payroll records, or contracts. For example, when a business purchases goods, the transaction is recorded based on the supplier's invoice. When cash is received from a customer, it is recorded using an official receipt. Without supporting documents, the transaction should not be recorded. Now, I would like to explain about the accounting concept of periodicity. The periodicity concept states that the life of a business is divided into specific time periods to measure its financial performance. Although a business operates continuously, accountants divide its activities into periods such as monthly, quarterly, or yearly. This allows the business to calculate profit and prepare financial statements regularly. For example, a company may prepare financial statements for the year ended 31 December 2025. Any revenue earned and expenses incurred within that year must be recorded in that specific period. I will be explaining about one of the list of documents that is invoice. An invoice is a source document issued by a seller to record goods sold or service provided on credit. Its main function is to act as official proof of a credit transaction. It shows important details such as the date, item sold, quantity, price, and total amount payable. This helps both the seller and buyer record the transaction accurately in their accounting books. In short, the invoice functions as evidence of a sale and ensures the transaction can be properly recorded and verified. Today, I will be explaining about one of the list of documents that is cash bill. A cash bill is a source document that will be issued when goods or services are paid for immediately in cash. Its main function is to serve as proof of the cash transaction. It shows details such as the date, item purchased, amount paid, and total payment. This helps the business to record the cash sale or cash purchase accurately in the accounting records. In short, a cash bill confirms that payments has been made and supports accurate bookkeeping.
So the next source document that I'm going to explain to you guys is credit note. Credit note usually will be issued by the seller to buyer to inform that buyer that their account has been credited. It usually happens when there is a return goods. Basically, the buyer may be return the goods that purchased from the seller. So, the seller need to send the credit note to the buyer to remind the buyer that their account has been credited. It is also an evidence of sales return. So the next one is debit note. Debit note is a source document that issued by a seller to a buyer to inform that buyer that their account has been debit. It usually happens when the seller understates the price of goods that purchased by the buyer.
Check is a written order from an account holder to a bank, instructing them to pay a specific amount of money to a named person or organization. Check also includes a detailed information such as date, payee names, signatures, income information, and amount in figures and words. So, the second source document is check bite, known also as check stub or counterfoil. So, basically, check bite is a small attached section that remains in the checkbook after a check is been removed. So basically, check bag is used to record important details of issued check, such as check numbers, check amount, check date, check payee, and check personal record keeping. So the last one is memo. Memo is a short for memorandum. So memo is a brief written message used for internal communication within an organization. Commonly, memo is used to share information, instructions, reminders, and updates between staff members and departments. So, that's all from me. Thank you so much. Bye-bye.